So how do interest rates affect your mortgage and monthly payments? I'm covering that today on this episode, so you want to stay right there. Welcome back. My name is Corpus. I'm a realtor in the Tri-Valley area in the East Bay of the San Francisco Bay Area, and I post videos every Friday about all things real estate. So right now, a common thing being pushed is, regardless of what's going on, the good thing about buying a house right now is you're getting a low interest rate. Now, I've sold houses for a while now, especially for first-time home buyers. Now, I've seen all kinds of interest rates, but I've never actually broken down and boiled down the actual benefits of a lower interest rate. And when we look at interest rates, let's just say they're in the range of 3 to 5% for sake of argument, depending on if you were getting a fixed rate loan or a variable rate loan. I want to actually break down the real benefits of having a lower interest rate and talk about what seems like a very complicated subject and kind of boil it down and break it down to see what it really means for your actual, not only monthly payment, but over the life of the loan. So in this scenario, I'm going to use an example, and the example I'm going to use is a $700,000 loan amount. Now, there's a difference between the loan amount you take on a house versus the actual price you buy down. For example, if I buy a house for $875,000 and put 20% down, my loan is $700,000. So in this example, I will use that amount, $700,000. It's just an easy number to use. It can be less or more in your particular area. So first, let's break down what the actual interest rate does on your monthly payment, or I guess for your loan. So using this example where we have a $700,000 loan and a 4% interest rate, here's what we do. If it's your first month where you're paying your first payment ever in your life, your loan amount is going to be $700,000. What they do is they calculate basically the percentage rate and they multiply it with your loan amount. So in this case, if you get a $700,000 loan, you multiply by 4%, you get $28,000. So what they do every month is they get the month's worth for that interest amount. So in this case, $28,000 being the annual interest they get from you, divide that by 12 and you get $2,333. So first month, you make a payment for the house and they're collecting $2,333 worth of interest for them. So now what's tricky here is there's always an amount being applied towards principal. Now, in this case, using 4%, the number that is being used towards the principal in this scenario is $1,009. So there's $2,333 being paid towards the interest, and there's $1,009 being paid towards the principal. So your loan amount will only go down $1,009. So your new balance is going to be $698,991 for the next month. So what do they do for next month? Well, now they use the new balance to figure out your annual interest amount. They divide that by 12 and they get this number, which you're going to see hasn't really changed a lot. So it's slowly starting to get lower every month you pay it. But what's interesting to find out is that the interest and the principal number that was initially in the first payment, those always add up to the same number. So as your interest rate is slowly, and I mean slowly going down, your principal is also increasing very slightly. It always stays that amount, even the last payment you make. The last payment you make in this 30 years later is going to be $11.10 for interest and $3,330.80 towards your principal, regardless of the month and the time. It always ends up adding to this amount. And why is it this amount? Honestly, I don't know. I'm sure there's someone with, a bigger brain that can figure that out. So now that you know how it works, I'd like to start breaking down 3 examples, okay? We're still going to use $700,000 as a loan amount, but I'm going to break down with a difference between, 3% interest rate, 4% interest rate and 5% interest rate. So each one of these scenarios are always going to add up to one thing. You're going to pay the $700,000 that you originally borrowed back. That's going to never change. That will always stay consistent because you borrowed $700,000. But what is that 1 point of interest really making? Well, at 5% interest rate, once it's said and done, once you live in the house for 30 years, you would have paid over $652,790 worth of interest, meaning you paid a total of $1,352,790. That's pretty much double. I thought we were, talking 5% here, not 50%. So, well, 5% is true. So I'm kind of working with the numbers a bit. So after playing with the numbers a bit, I wanted to find out what interest rate would actually make me pay double the amount that I borrowed in interest. So what is technically a 50% interest rate? I found that 5.31 is the number that would literally make me pay $700,000 in interest, $700,933 actually, and $1.4 million in total. So we're talking 5%, and we're talking basically close to double. And as you can see there, the monthly payment is about $3,757.75. Now that is just a principal and interest payment, and it doesn't include property taxes nor insurance and whatnot. So when looking at 4% interest, here's what we find. Monthly payment goes down to $3,341.91, which is not bad. That's like a difference of $416 a monthly payment compared to the monthly principal and interest payment at 5%. But you're noticing that the total interest paid goes down dramatically. If the math is correct, you're paying $149,702 less just for that 1 point of interest. Now, if you live in this house for 30 years, $149,702 is a lot of money. And last but not least, at 3%, we're seeing the monthly payment go down to $2,951.23, and the total interest paid for the life of the loan goes down to $362,443. The delta for the overall life of the loan interest paid between a 5% rate and a 3% rate is a whopping $290,347. That's quite a difference over the life of the loan made out to the lender that you would have paid just for 2% spread in interest rate. Another thing to note is that the payment between a 5% rate and a 3% rate for the same loan size of $700,000 is 27% more in monthly payment. Buying power goes down as the interest rates go up, as buyers aren't able to qualify for as much for a home loan. As mortgage rates potentially continue to rise, buyers are more so considering the differences of how rates affect their buying power. And we've seen more buyers choose 30-year fix in the more recent years, with 30-year fix rates being as low as in the 2s and 3s. And now that they're in the higher 4s and above 5% sometimes, buyers are now considering adjustable rate mortgages as a viable alternative to a 30-year fix, knowing that on average, most people refinance their existing home loan or sell their home within a 4 to 7 year time span. I still have yet to meet someone that has kept their same exact loan for the full 30-year term without refinancing or selling their home. When it comes time for you to make a decision on mortgages when you purchase, just keep in mind that although 30-year fixed rates have risen to above 5% as the national average, they're still at an all-time low, and that you have choices to make, such as buying a lower priced home, taking an adjustable rate mortgage, paying points to buy down your interest rate. And what's most important is that you are comfortable with making the monthly payments for the loan type you choose, and know that financing is never permanent. If mortgage rates do drop after you close on your home, you have the ability to refinance your home to lower your monthly housing payment. If rates continue to increase, you'll be happy that you locked in your rate when you did. And as a renter, You really don't have the ability to lower your monthly rent payment to your landlord when mortgage interest rates drop. Homeowners do have the fortunate advantage to decrease their monthly housing payment with subsequent refinance opportunities when rates eventually dip in the future. So the mortgage market, like any other market, goes through up and down cycles, and we just happen to be on an upcycle currently. If you found this helpful, do me a favor and give it a thumbs up and subscribe to my channel. You may also want to check out my past video on the 10 questions to ask your real estate agent when buying a home in the San Francisco Bay Area. The link to that video is on the top corner of the screen. Again, I'm Dale Corpus from eXp Realty in San Ramon, California, and I help buyers and sellers throughout the Bay Area and Tri-Valley, and I'll see you on my next video.